just threw down 2 days live stream. A little happy hour, a little dinner. We got an event planned, Q4. Yes. Stay tuned. Yes. We're going into the events business. Robbie, Andy, the boys. Shout out.
2 straight days, live stream straight from permissionless to Rollup TV. Coming for the #1 spot. Don't wait up.
See you around the timeline. Feels good to be back.
All right. Bang. Hope you guys like the new intro. We are live. Happy Friday. Markets are chopping left and right. No matter what, we go live. We keep bringing you guys the absolute state of things going on. Animal spirits. When you have a 50% decline in open interest, you rebuild the animal spirits from the ground up. Hope you guys are fired up. We're going to have a great Friday, great weekend, great show for you guys today. First up in the back, we've got Dominic Ryder, co-founder of Alvara. These guys are they're going to do something great. We've got him in the back getting set up. We're going to get him going. Particularly excited today, we've got the head of innovation of Janus Henderson. Janus Henderson is a massive capital allocator and asset manager. They are on Wall Street. They don't play. They're starting to dip their toes in tokenization and internet markets, internet finance. We're going to get Nick fired up to be on chain. Then we've got Tony McLaughlin, founder of 𝘬𝘮𝑗𝑠. 𝘬𝘮𝑗𝑠 is another just institutional partner. These guys, they're coming on chain. They're coming to buy your bags. Will you let them? Will you bend the knee? Will you fold to the institutional capital allocators for a certain price, right, guys? And then Dan, co-founder of Wormhole. We're going to wrap it up with a nice crypto native big bang, send it into the weekend hot. Before we bring before we bring Dom, our first guest, up on the show today, I want to show you guys a little bit of something that we're seeing in the data-driven theses side of the industry. Archimedes, these guys produce great data. We're just going to run a little screen share for you guys. This is part 2 of their stablecoin payments report. Guys, we're bringing you everything you need to know about stablecoins from the ground up. These guys are doing great work. Stablecoin payments hit $10 billion monthly, up 70% since January. It's a stablecoin super cycle, guys. You guys should already know that. Up 70% since February, 137% since last summer. Pretty insane that we already have this level of growth happening. All right, let's keep moving. Stablecoin payments climbed from 6 billion in February to 10 billion in August. Pretty nuts there. A 70% increase in total. More than 136 billion in payments have been settled since 2023. A Cambrian explosion of stablecoins coming to the market. Let's speed run through the rest of this. B2B is driving the market's expansion. Again, since February, B2B volume grew 113%, reaching $6.4 billion per month. Stripe, Tempo, all of these guys, stable chains are here and they're coming and they're capitalizing on the opportunity to facilitate payments, representing nearly 2/3 of all stablecoin payments. That's B2B volume. Consumer channels followed. Card up 36%, B2C up 32%, pre-funding up 61%, while peer-to-peer remains stable at 1.6 billion. As you guys can see, we've already kind of mastered the peer-to-peer payments market. This is remittances. These guys are sending directly. Now we're helping people that are typically using some other enterprises or some sort of intermediary to help facilitate their payments worldwide. Now those intermediaries are using blockchain rails. Peer-to-peer, we've dominated that market for a while. Tether continues to dominate with a 79% share of stablecoin volume. Circle's USDC is gaining ground, increasing from 14% to 21% since February. Now you can see we're really seeing developments in the stablecoin market. Tether is starting to take a more regional approach. You've seen USDTO, you've seen USDT Europe and gold. These guys are starting to expand and taking a more regional and geographical approach to stablecoins. This is how we expect the stablecoin market to mature. Tron continues to lead global flows at 48%, while Ethereum is bolstered its position up 11%. Guys, Tron is beating Ethereum when it comes to stablecoin volume, even though stablecoin assets are predominantly on Ethereum. I think there's more than double the stablecoins on Ethereum than on Tron. The velocity of stablecoins and the flow of capital is rapidly accelerating on Tron. The stablecoins on Ethereum are predominantly just sitting there, farming capital, being used for lending and borrowing. On Tron, these stablecoins are being used for payments. We're going to put together a massive clip of us going through this Archimedes data. Geographically, again, this is how we expect the stablecoin market to mature. The U.S. is leading 18.7%. Singapore not far behind, 18.4%. Nearly 40% of all stablecoin payment flows. Hong Kong just about 10%. Japan 8%. UK 7%. Round out the top 5. This is not emerging markets anymore. Massive data coming out of the stablecoin market. Couple more things that I want to show you guys before we get Dom on the show. Let's see. I want to show you guys this. This is tokenized collateral will be the norm within the next decade. I think this is huge. You also see JP Morgan making multiple announcements into a more bullish sentiment. You have them talking about the end of quantitative tightening. You have them talking about institutional clients now using Bitcoin and Ethereum as collateral. Earlier in the year, not sure if you guys remember, but news out of the administration said that we're going to be able to use crypto as assets to prove our eligibility for a mortgage. This is going to kind of open up the housing market for crypto recipients. And now I think this is another massive announcement. What we're seeing is more and more institutional capital and access to the crypto markets from these enterprise clients. JP Morgan to allow institutional clients to use Bitcoin and Ethereum as collateral. We're no longer going to need to sell this collateral in order to gain margin. I think this is a huge development, and we're just going to see more and more of this. The last thing I want to show you guys before we get our first guest, Dom, up on the show is that Polymarket said there will be a token. I'm not sure if you guys can hear this video, but it's pretty insane that the CMO of Polymarket, it wasn't even Shane, the CEO and founder of Polymarket, who made this announcement. There will be a token. There will be an airdrop. You guys know us. We are big fans of prediction markets on this show. I'm sure everyone is positioning quite lucrative. All right, guys, without further ado, I think we've got Dom in the back. Let's get Dom up on the show. Let's get him up on stage so that we can have a chat about Alvara. They've got a ton of very, very cool things that are happening. They're building baskets, and they're building the platform for the next generation of tokenized basket managers. Let's get him up on the stage when he's ready. I think there's tons of things that are happening in Wall Street as we get the green light for some indices products, and we get the green light for some of these tokenized basket products. Dom, welcome, man. It's the first time on the show. Appreciate you coming on.
More flip-flops than the local beach. The amount that they go back and forth on, it's a scam. It's the next best thing. Yeah, they can't make their mind up, but slowly they all come.
That's right, man. And they certainly are. I'm old enough to remember, I'm sure you are as well, when 𝗵𝘗, who said it was rat poison? Was it Warren Buffett that said Bitcoin was rat poison? I think that was Warren Buffett, but Jamie Dimon was right behind him, man. They were tooting from the same horn, both with the same sentiment.
Yeah, even a year ago, I think it was at the they've got this banking regulation, Basel II.
Yes,
I think
Basel II or III. Yeah.
Yeah, and he was even then a year ago he was saying it's for money laundering.
Yeah.
I mean, it's like any innovation. It's about they need to position themselves before they. It's like with 2008. Obviously, Goldman Sachs was selling all of their collateralized debt obligations to AIG, American Insurance Group, and then only when they had a large enough short position on the assets that they were selling them themselves did they finally start marking them down. As in, they wait and confirm, and once it's in their interest, then it's the best thing ever or worst thing ever, because it's all just the game, and they are king shark.
Yeah, that's why the old adage is that these guys fill their bags before they let the market rip, right?
Well, exactly. If they're talking badly about it, that's when everyone wants to buy low and sell high until it's time to buy low.
Yep. Yeah, facts, man. Well, you've seen it all. You've been in the space for a long time, but it is your first time on the show, so maybe you could just give our audience a little bit of some background, some intro on Dom's lore. How did Dominic Ryder arrive to the position where he is today?
I like the lore. So I started out on what was supposed to be my gap year. I was going to study sociology at university, but I started a commission-only role as a junior stockbroker at a derivatives firm. 250 cold calls a day, commission only, eat what you kill, and if you don't kill, you die. So I loved that. My ADHD was just tuned in, and I did very well. So I sacked off university and took my Chartered Institute of Securities and Investments. By the time I left there, I was senior trader and head of desk. I then moved to St. James's Place Wealth Management, which is a FTSE 100 wealth manager here in the UK as associate partner. And then after that, I joined a VC, because going from derivatives, which is about as close to gambling as you can get and still be regulated, to suitability reports, financial advice, and it was just, someone had popped my balloon. So went into venture capital, sort of asset-backed investments, renewable energy, for just a London-based firm. And I started in crypto full time. Obviously, I being an ex-trader, I'd heard of it, and I bought it back in like 2018, maybe after it had started dipping. And then, of course, the dip keeps dipping for another 2 years. In traditional finance, I found that even though I had done very well for myself, because I didn't go to university and because I was never privately educated and I was state educated, whenever I would give my opinion at my VC in particular, because it's very nepotistic, especially in the UK, a lot of class. And I'd give my opinion, and even though I had sort of 10 years of very senior positions in finance, the immediate reaction that you get is, where did you study and where did you go to school? AKA, should I listen to you? Are you my kind? Are you from my ilk? And so because I, wasn't university educated and wasn't privately educated, it doesn't matter about how much experience I had and how senior my previous positions are, I wasn't in the club. And so that really annoyed me, because same thing if I applied for JP Morgan, Goldman Sachs, the tick box comes up of where you studied for your degree, and if you don't tick that box, auto filtered out, never even get a chance. And so with Alvara, what we've tried to do is create an actual meritocracy where fund management is decentralized and accessible, where anyone can manage a fund, mint a fund, and even in the future sell the rights to one of these, all on one platform, and doing that with a token standard so that it is actually standardized. People can compare apples and apples. But yeah, I think that was quite a lengthy intro.
I love it, man. It's no surprise that you ended up in crypto. You know, there's a group of misfits here and libertarians and just people that believe in the meritocracy as it's meant to be, rather than the nepotism that you described. Nepotism not just in familial ties, but also ties to the incumbents and the institutions, the people who are maintaining power for the sake of maintaining power, not because they continue to innovate. But around here in crypto, we call it adapt or die, and I think you have certainly embodied that mindset. And so has Alvara. And so I'd love to dig a little bit deeper into some of the things that you guys have done, because you've been able to build some of these tokenized funds, products that have existed in the traditional financial space, but now are coming on chain. You decided to go on chain first and skate to where the puck is going. And now it's a matter of, look, you're innovating quicker than these incumbents are able to innovate. And I think it's just a matter of maintaining and growing that distribution channel before these things really do converge. So give us a little bit of an intro. What is Alvara? Why do you think tokenized funds are a financial product that will thrive on chain? And generally, continue the story. Founding Alvara, how have you found success on chain so far?
Yeah, so I think there's been a lot of entrance to this sector of DeFi, if you like, with even going back to 21, you had index co-op.
Right.
The main sort of differentiator and where I spotted people were, in my opinion, doing it wrong is there's two types of funds traditionally in sort of asset management. You have passives like Vanguard. Vanguard, low fees, it tracks an index. You know for a fact you're going to underperform the index by a little bit, but that's okay because it's easy and cheap. And then you have the active management. Active management is more expensive because you have a leader. You have someone who you trust, who has hopefully a track record and whatever, in order to basically have them manage your assets. The most famous fund manager in the world, Warren Buffett. He's an active fund manager. You invest in Berkshire Hathaway because of Warren Buffett. If it wasn't for Warren Buffett, you'd stick it in Vanguard or with somebody else. And so there was a lot of innovation in terms of indexes and passives and, gaining actual exposure to a sector or group or, a little niche of crypto. But passive investing is boring. Like, the rock stars are made in active management. That's where your Charlie Mungers, your Warren Buffetts, your Neil Woodford, your Terry Smiths, your, giants and characters of the fund and asset management industry. I mean, I say rock stars. I don't think Warren Buffett's been called a rock star for a long time. But, you have these people are rock stars within the fund management world. And so passive strategy is just, slow, steady, and but it's just not, it's not where the spice is. It's also not where the predominant amount of assets under management are. And so no one was really building for that. And the reason why is the fact that to be an active manager, you need discretionary permissions. Therefore, you need to trust a manager in order for them to change weightings, because that's the whole point of an active manager. Is with an index, you're constantly invested, which means that you can have no leeway or any time out of the market, and no flexibility, no predictions of if things are getting overheated, etc., etc. With active managers, you pay that premium for the manager's insights to that and for the flexibility. you trust that, for example, Warren Buffett has had the highest cash levels ever when we had sort of the crash that we saw in 2022. And that's because you expect that, that wasn't just luck. He saw that was probably going to be profitable because it's yielding 5% and the stock market was overheated at that time. And so these are the insights that people weren't really building towards. And I think part of that is not a lot of people have necessarily worked in that industry. Now we're seeing a lot more people enter from traditional finance into crypto. But back in like 21, 22, these people have paid very high salaries. And therefore, there isn't really the even sideways step if they want to earn the same amount of money and have the same security. That's changing as the industry matures. But back in 2022, it was just sort of the trailblazers and the risk takers. I was going to say retards, but
you can say that on this show.
But it's the people who have a bit of a bit of degen in terms of they want to change something, and that is sometimes revolutionary and it is sometimes retarded. There's a very cross line that you need to walk. But so Alvara was built for the active management industry because that's the predominant market. And yeah, the competition was very much leaning towards passive because it is safer. You don't have to trust a manager. However, if you build for the market that is easiest and not for the market that exists, you're never going to actually get mass adoption. Right. You're just going to get niche adoption. It's like when I see we're a crypto insurance protocol and we insure DeFi. Like what is DeFi insurance? 0.0001% of the market. Like, why are you insuring a niche? Like, there's no customers. Mm-hmm. If you're going to build an insurance protocol, insure people's lives, life insurance. Everyone has it if they've got family, if they've got a mortgage to protect. That's where we need innovation. Like, I just see people shoehorn themselves into what they actually try and target and solve because they go for the easy option, not the mass adoption. And they do that for a reason, but that's not how I roll, I guess.
No, we think big around here. And so you guys have actually taken an ERC standard and used it to your advantage to build some of these products that you're describing. And I'm curious to dig a little bit more into the tech because you talk about the difference between passive investing, active investing, and how that leads into some of these financial products. On chain, we have these token standards and we can really bundle some of these things together. Why was it so important that you guys use this particular standard? What is it about this standard? Give us a little bit of market education around the ERC 7621 so that we can kind of understand more the prowess and the capabilities of the token standard and ultimately of the baskets that are available on Alvara.
Well, Alvara invented the 7621. So we had to use it. There wasn't any like I mentioned, there's a lot of individual protocols innovating within this sector, but nobody has a standardized way of doing this. Everyone does it their own way, and therefore that opens up sort of comparison risk. The reason why, if you look at any fund fact sheet, like they all have the exact same way of data. They have cumulative performance, annual performance, and breakdowns. And therefore, you can look at one fact sheet from one person, another fact sheet from someone else, and you can compare them. If everyone is using their own way of coding one of these, then it gives the get out of jail free card. Like, well, the reason why the Alvara gaming basket has done this performance, but the index co-op gaming basket has done this performance is because of the way it's designed. If it was designed our way, it would have done this. And it just gives that, it muddies the water to make it seem deep, when in reality, it's just a get out of jail free card. And so if you don't have a standardized way of measuring this, then you open up these sort of loopholes, I guess. I don't want to say exploits because a crypto term, you know, has that has connotations, but it's a behavioral exploit. If someone's trying to sell something, they'll hone in on that straight away. So that's where we saw the demand is we need to have a apples and apples comparison rather than an apples and pears, because that way it's the same with OpenSea, for example. So OpenSea, it doesn't matter if you mint a 721 or a 1155 off the platform, as long as it fits the standard, they pull it through and they aggregate it.
Right.
You can mint it on the platform, of course, but they are open to everyone. And so what we are looking to do with the 7621 is not only become, you know, the go-to aggregator, but take the first mover advantage as if OpenSea invented the NFT at the same time. Because, you know, when people think about the NFT, and like when Disney came on and did a collection, when Pepsi did a collection, they didn't even think about the fact, oh, shall we use the 721 or shall we use our own for this? They just did the 721 because the 721 was the NFT and the NFT was a 721. It was obvious.
Right.
And so we want to create that obvious choice, because for people who, you know, I would like to say, obviously see that the funds, stocks, shares, and tokenized assets are coming on chain, obviously, then there needs to be a token standard for that. There needs to be a standard way of comparing these things. Because if everyone just does it themselves, then it's you know, somebody is going to do this.
Right.
And so that's what we've done. And it also means that we become that go-to aggregator where anybody from any background can come onto the platform, mint one of these through a factory contract to their wallet and become a manager.
Yep.
It doesn't matter if they have a CFA. It doesn't matter if they have an IMC. It doesn't matter if they have a master's, a degree. Anybody from anywhere can mint one of these, and your performance stands for itself against everybody else. Institution against retail, pleb against genius. It allows for an actual like-for-like comparison from every person to the next. And yeah, that's sort of the overall. I mean, in terms of the 7621's functionalities and how it works, the best way to describe it would be like a smart wallet, which is the ERC6551. But if I simplify it a bit more, an NFT that can fit infinite amounts of other ERC20 tokens within it.
A basket, a container.
Exactly. The part that makes it unique is the fact that the token standard itself is an interface that allows you as the owner to change the overall weightings.
Okay.
And whenever any outside participant or user contributes to that token standard, it automatically mints them an ERC20 LP token representation of their part of the 7621. So every 7621 has a unique ERC20 LP token associated to it, like how Uniswap V2 works.
Right.
Which means that as a 7621 manager, you earn fees from the assets under management.
Right.
So therefore, you can add liquidity to that ERC20. You can build staking, governance. You can build derivatives, lending strategies, arbitrage, anything that can be innovated on top of a normal ERC20 token, you can build around your 7621. Which means that us as this very bottom layer infrastructure, allowing anybody to mint these to their wallets, we have the ability for hundreds, thousands, or tens of thousands of individual sub-DAOs and sub-protocols, all built on top of our infrastructure, where we are the aggregator for all of these.
I get it. And you've been around a long time, and I can remember when there was decentralized hedge fund products, financial structured products, where you could have kind of this open source nature to them. You could have kind of this permissionlessness nature to fund managers. I remember the likes of Enzyme Finance, D-Hedge. These were some of the early innovators in this ecosystem. And these guys sort of, you know, they kind of came and went. You guys are sticking around. You guys are surviving. And now we're seeing institutional assets come on chain through this tokenization movement. And I'm just curious, and you know, I'm sure we could go on and on, but I think we only have time for maybe one more question here. And I want to get your sense of something. The platform, as I understand it, is very open. It's very friendly and accessible, and it's really permissionless. It allows anyone to come in, build one of these baskets. What we're seeing is all of these assets come on chain. These are a lot of enterprise assets. And so, if I go on the platform now, I might see, some kind of degen mix of, dog with hat paired with SPX 6900, right? Like all of these really, really wild combos. But the potential that we see here, and I think you see it, I see it, is the potential to also combine some of these things with BUIDL, like these BlackRock things, these AAA rated private credit CLO things, these financial and structured products that have enterprise level scale, but permissionlessness nature, and fund managers that are totally open access. How do you balance these two worlds where you kind of open these things up for the long tail of asset managers, but maybe you're sticking to the meat of enterprise level assets?
So we have a phrase in the UK which is "look after the pennies and the pounds look after themselves." And in terms of sort of number one, the ease of the platform and the ability for anyone from anywhere to mint one of these facilitates the mass adoption. It populates the 7621 standard on chain and everywhere. In terms of the bigger players, like I say, similar to how OpenSea does not require, because when somebody mints through the factory contract, 5% as a minimum holds the Alvara token. So it's not a fee, it's a stipulation. And you'd hope if they're using us, then they're 5% bullish on us anyway. But because obviously institutions have mandates, if we forced a commodity brokerage to have 5% Alvara, they're just not going to use it. And so anyone can code a 7621. We still recognize it and pull it through. It doesn't matter if it's minted through us or not. And then they don't have to have the 5% Alvara. So that's why the 7621 is open source and as a token standard, it can't be. What we've done, which makes it attractive for institutions, whilst maintaining a meritocracy for everybody, is that we have taken the same gauge weight governance structure of curve finance and applied it to Alvara's basket LP tokens. So just like you had Stake DAO, Yearn, Pickle Finance, Beefy Finance, Convex, all building on top of and trying to accumulate as much VE Curve as possible to incentivize the DEX pools on Curve, we've applied that mechanic to the LP tokens, meaning that if you are a institution or a whale or whatever, the more Alvara you buy and the longer you stake it for, the more voting power you get. The more voting power you get, the more yield you can send to your 7621. So not only do people get any potential upside, but they also earn a yield just from contributing to it, which means that you as the manager grow your assets under management, which means you earn more fees. The more fees you earn, the more Alvara you can buy, the more you can stake. And it's a self-fulfilling turnstile of accumulation incentive. And just like you had the curve wars, where you had all of these yield aggregators fighting for as much VE curve as possible to give their DEX pool the most incentives, we've taken that mechanic but applied it to the potential of tens of thousands of individual funds fighting for that.
Very cool. Awesome. Man, Dom, pleasure. Thank you so much for coming on. Wish we had some more time to dig through some more of these implications. I think we really got a sense of what Alvara is capable of. There's significant knock-on effects, second-order consequences to this. Love to have you on again sometime soon, and we can talk through those. We're gonna keep it moving. Thank you so much, man. Absolute pleasure. We'll see you again soon. Cheers, brother. Beauty. Yeah, I remember Index, Co-op, D-Hedge, these guys. We even tested some of these things out. They were pretty popular back in 2021. I do think as this technology evolves, Alvara is going to pick up right where they left off and continue to pass on the torch and pull it forward. So we're really, really stoked. Alvara is a great partner. We're gonna let Dom continue to move on about his day. Next, we've got the head of innovation at Janus Henderson. Nick, this one was actually pre-recorded a little while ago, but guys, stick around because this one is an absolute banger. You don't want to miss it. There's tons of alpha. I think there's also just a really interesting way of looking at things. And I've started to incorporate it in my own mindset when I'm thinking about the convergence of Wall Street and digital assets. So we're going to get Nick up in just a moment. And guys, you don't want to miss it. We'll be right back with Nick from Janus Henderson. Let's play the interview. Nick, the head of innovation of Janus Henderson, a massive player in the traditional financial space. TradFi, DeFi are converging. It's just becoming finance these days. So it's a pleasure to have you on the show and talk about tokenization and all things digital assets over at Janus Henderson.
Yeah, great to be here. Thanks, Robbie.
Absolutely, man. Let's jump right into it. You guys have some pretty significant partnerships. $1 million, if not $1 billion in RWA funds that are going live. Maybe you can start off just by tracing what is the holistic view of crypto from Janus Henderson's perspective, and get us caught up on how you've been approaching this and seeing this landscape.
Look, obviously there are a lot of different threads, but big picture, I think we are heavily convicted that probably the most transformative technology for financial services, over the coming decades is going to be blockchain. And really that means that eventually virtually all of the kind of traditional financial system will migrate onto blockchain rails. And so if that eventuality comes to pass in 20 years, that is a very different kind of set of implications for us, for our business, for our clients, than if it comes to pass in 5 years, right? And the question for us is, how do we engage in that in a way that is, I would say, like responsible to the current reality, which is that the overwhelming majority of the global financial system is not there yet, right? And so, it's been a really interesting journey, and we've done some great things on the tokenization front, and then thinking about, what are the other ways where now there is like real activity that we should be doing and engaging in preparation for that eventuality.
Yeah. Okay. That makes a ton of sense. And I think we'll have a little bit more of a forward-looking, future-looking conversation about what the end state looks like in that reality, because I think we're all sort of operating on a similar premise of going in that direction. I want to just shout out some of the statistics of Janus Henderson and specifically the Anemoy AAA CLO fund that you guys are working on with Centrifuge. $850 million in total asset value. You guys have it currently split between 3 chains: Ethereum, Avalanche, and Base, predominantly on Ethereum, over half of it on Ethereum. 0.4% in terms of management fee. This looks like a classic investment vehicle for the more passive investor to get some yield. Maybe you could talk a bit about where you're seeing the demand come from to explore this, put this on chain, and ultimately continue in this direction. Was this something that you guys heard from your investors in Janus Henderson and they were pushing you in this direction, or was it something that you guys foresaw before your investors came to you and you wanted to serve them because you felt like this was the best to accomplish their investment goals?
Yeah. So this ties in really a lot to that kind of journey that I was just talking about, where we see things going. And if we oversimplify it, right, there's really 2 big pools of capital in the world today. There's on-chain capital, which is massive, right? I mean, even if you take away from that all the value that's sitting in Bitcoin, there's still a massive pool of on-chain capital. And then you have off-chain capital, right? And there's kind of this view, or our view certainly, that eventually all of this off-chain capital becomes on-chain. And your comment at the outset, right? Like DeFi and TradFi, they cease to mean different things, right? Today, though, I think a lot of the benefit for investors who want to bring kind of traditional assets like AAA CLOs on chain, it's not so much for off-chain investors to come on chain because they can already access those assets off-chain, right? And so the way that we see this evolving is that there is a need for very high quality assets to be brought on chain first. And the users there are on-chain users. So it's large institutions, largely, who have significant pools of capital on-chain already, whether that's from protocols, whether it's from layer ones, foundations, all sorts of businesses that are very scaled, very dynamic businesses who are doing creative things with the kind of future of finance and the things that can happen when you use blockchain technology, but they're sort of been constrained to only digital assets, right? And a lot of the use cases and a lot of the kind of business needs can maybe be met with some traditional assets. And so that probably started with stable coins, right? And this is obviously, very hot topic in traditional finance, but the reality is a stable coin from the perspective of like a traditional investor is still a pretty boring instrument, particularly if it's not yield bearing, right? And so how do we move from there into many of the other asset classes that are critical for institutions to manage their portfolios, right? CLOs, AAA CLOs is that sort of incremental movement away from stable coins into a higher yield bearing asset, but that still is very low risk. It's AAA rated. It has very little duration risk. The underlying asset class is incredibly liquid, et cetera. And so all of that movement was really triggered by us or from us by the Maker DAO RFP, which was the first really significant institutional RFP where they wanted to bring $1 billion of tokenized treasuries on chain. And so we launched JTRSY with Centrifuge and Anemoy to meet that need. And then that very neatly evolved into AAA CLOs with Grove, and then now additional partners and users who have come on chain. But I would say there's very few cases really just across the entire ecosystem of significant off-chain capital moving on-chain to access off-chain assets.
Right. Yeah, absolutely. It makes, it's just common sense, right? Because if you have off-chain, that entire world you can continue to operate on, you're bringing it on-chain as the GDP of the internet grows. And I think this is indicative of the broader trend where, back in 1999 and 2000, 2001, there was internet companies and then there was regular businesses. And then ultimately what you're seeing now is regular businesses all operate on the internet as well. And so internet companies, as more and more companies, if not all of them at this point, become internet companies, they need internet money. And that's where stablecoins come in. As the supply of stablecoins continues to grow on chain, it makes sense for them not to go off chain, to go find some of these vehicles that you're describing. Makes sense that there's now on-chain vehicles, there's internet investment vehicles for internet money for internet businesses. And as the GDP on the internet continues to grow, we're just going to continue to see more and more of this. I'm curious.
I think just on that one thing, I think the key catalyst there, or the key driver for your analogy of sort of internet companies, is that if that ecosystem stays closed, right, and it's just people sort of shouting into the void about how great their solution is, the pace of growth will not be anywhere near as significant as if they're proactively bringing these sort of traditional finance businesses along. Because as soon as that reaches a tipping point, that's when every company becomes an internet company, right? Every financial services firm has to be on chain, but they're not going to do that first. So this sort of massive growth that we're seeing right now in RWAs is, to me, like a critical component of that transition that we've been missing. And stablecoins have started it, and now we need to extend it beyond that.
So could we zoom out just for a moment and could you give us a bit more of an insight into what Janus Henderson does? What is their typical, their main core business, and why do you think Janus Henderson is one of the more pioneering financial institutions to go into this world?
Yeah, listen, we're a very traditional global asset manager with 450 billion of assets. We have, more than 2,000 employees located around the globe, heavily US and UK based, but, offices everywhere. And we service a very, very wide range of clients, right? But they all look very much like traditional asset management clients, right? So we have a large business serving institutions, We have a large insurance company presence. We have a lot of individual investors. We work with a lot of financial advisors across the US, Asia, Europe. So we look like a very sort of traditional diversified asset manager. And I think, over the last 10 years since I've been at the firm, and certainly over the last 2 or 3, as we've gotten more and more people in management and our boards, et cetera, who are really interested in thinking about how we build the asset management manager of the future. Like, how do we really prepare for the next 10 years instead of sort of sitting on our laurels of the business that we've built over the last almost 90 years? Blockchain becomes very clear, right? And blockchain is for us part of a larger innovation strategy, right? It happens to be the component of that I think is the most impactful, but it's not like an isolated, we should be in crypto, right? It's how do we think about innovation over the next decade? How do we think about how we engage with our clients differently? How do we think about AI? How do we think about our social impact, right? It's all these pieces. It's just that blockchain is the one that is so uniquely, it's like one of the largest trends going on in the world today that is just very explicitly relevant for financial services firms.
Yeah. And I got one quick question, and then I'd like to ask you about the asset manager of the future and what your vision for that is. Quick question though, on your partnership with Maker and with Centrifuge and developing $850 million, that represents about 1 billion out of 450. It represents 0.25% of your total assets under management at Janus Henderson. And so when you were thinking about this, were you thinking about this in the way, look, we have to put something on chain and start building this out because it's a greater risk if we don't? If most of the blockchain is capturing and housing finance over the next 2, 3, 5 years and then beyond, we're going to be caught flat-footed if we don't go and put some portion of our assets and our business on chain.
Yeah. I mean, look, you're right that from a just pure commercial standpoint, revenues to the firm today, it's not a material portion of our business, right? But the whole thing is, if you want to win in the future and you want to win a decade out, and you see that more and more of finance, right, our business, but as also our clients are going to move on chain, then the way you win is by being a leader, being early, right? And so eventually, right, the reason that we see all of these assets and all of these businesses moving on chain is because there's the potential for very significant improvement in the client experience, right? It's, programmatic 24-hour access, it's ease of custody, it's all these other things. And then also cost reduction, like the potential for very significant cost reduction. There's so much cost built into the financial system because of frictions that are driven by intermediaries. And if we can eliminate those or reduce them significantly, that is material. At some point, our clients are like kind of traditional clients. So not our new clients in the kind of DeFi universe, but our traditional clients in the, old private banking universe or whatever kind of area you want to look at. They're going to say, hey, listen, we understand that there's real value here. How do we get there? And they're going to want to work with the firms who understand it already, right? And so we want to be ahead so that when that transition happens, we're well positioned to help our clients make the transition with us.
Another part of that transition that's happening at the same time in parallel is this wealth transition that's happening from this baby boomer generation to the millennials to the Zoomers. And this is going hand in hand. It's coinciding with this increase in technology and this acceleration of blockchain, AI, these sorts of things. So getting into what is your future state of finance? What do you picture as the asset manager of the future? Is it more peer-to-peer? How do you envision this landscape shaking out?
Yeah, I mean, the generational wealth transfer that you're talking about is like the biggest demographic wave that is going to define like major industries and certainly finance, right? There's just an incredible amount of wealth that is going to be transferring over the next 20 and 30 years. And if you go and talk to a 30-year-old about how they engage with financial services firms, their expectations are completely different than a 70-year-old, where most of the wealth is today, right? And so you see this with neobanks, you see it with robo-advisors, you see it in all these different ways where I think the client of the future is going to expect very, very, very modernized real-time access to their assets, more usability, all of those things, right? So the way I describe blockchain to people who kind of are not in the space and why it's relevant to us is that it's sort of the equivalent of the iPhone, which is that the iPhone, when it came out, created whole internet businesses that nobody really considered until the App Store existed, right? And blockchain is going to do that to finance. We don't know what those things are, right? I don't know what the next kind of breakthrough invention is going to be when the amount of investors that are operating on chain has reached critical mass, the number of products that are available on chain has reached critical mass, right? But the usability of those assets will completely transform, right? If I can use my S&P 500 investments to make a mortgage payment, like that's totally different, right? And so that those types of ideas are going to lead to new business opportunities. And so for us, it's like, how do we get there, right? Like, we're not going to try to predict what the future is going to look like 20 years from now and build it today. We're going to try to be sort of on the cutting edge of that cresting wave, right? And so what does that mean? It means us basically continuing to innovate in terms of products that solve real client needs in terms of their investments. Our purpose as a firm, we say, is to invest in a brighter future together with our clients. And what does that mean? It just means a recognition that what we do in asset management isn't being done in a vacuum, right? It's being done for individual people to lead richer financial lives that can lead to richer overall lives. And like blockchain, I think, is very aligned with that core vision, which is how do we make the financial system serve individuals, right? Yeah. And so we don't pretend to know what the asset manager of the future will be. We want to be ready when we figure it out.
Yeah, and it certainly is. The way you're talking about and thinking about it is similar to what we see on a day-to-day basis in the crypto world. We're disintermediating, and that is leading to capital efficiencies, and that's lowering costs and ultimately giving a better experience back to the end consumer. And as we do that and we innovate step by step, it ends up as a completely new modern experience that looks almost entirely different from what it looked like before we made those incremental improvements. Yeah. And you're right, we don't know exactly what the end state is going to be, but it's our job to get to this critical mass. So I'm curious, what does critical mass look like inside Janus Henderson? Right now, you guys have 850 million in this tokenized CLO fund. How much of Janus Henderson's 450 billion in assets do you anticipate to come on chain to reach critical mass?
That's a complicated question because it depends upon the sort of like the metric in which you're thinking about that, right? So there's like the very narrow view of a traditional asset manager. For most of my career, I've built ETF businesses. That's what I've been in charge with for most of my career at Janus. And starting 10 years ago, we now have 40 billion or so of assets. It's a material part of our business. So just like from a pure AUM basis, you need to be in that 5, 10, 15, 20% of assets or revenues or however you want to measure it for it to start to really drive the business. But the thing is, there's the revenues and then there's the growth, right? And marginal businesses from a kind of gross revenue perspective can be very, very relevant from a marginal revenue perspective if the growth rates are high, right? And so already today, right, what we're doing in blockchain is a core part of our strategy. We are like very deeply engaged in it across the organization in many different ways. We're talking about it with our investors. So I would say from that perspective, from like a focus and attention perspective, it already is there, right? From a tokenization perspective, right, I think what will actually happen is that we will continue to grow sort of the tokenized business, right? RWAs, like that piece of it. And that's not going to suddenly eclipse the rest of our business. What will happen is we will get to a certain point where all of our core business will be at a point where it just moves onto blockchain rails. And the line will just disappear. And we won't be talking about RWAs anymore. It'll just be like when you buy investment products from an asset manager who is a sophisticated asset manager, the expectation is that is happening on blockchain rails, and therefore you're realizing the benefits of cost efficiency, transportability, all those things that we all see as the future.
Yeah, very cool. We're almost out of time. This has been a lot of fun and really, really great. Nick, just to close out, sometimes we do this with people that have cool takes, and I'm just curious, just to be a little bit reductive to close this out. Like, what are you bullish on? What are you bearish on? Just in this general, like, without giving financial advice, none of that, but just categorically, when you're holistically looking at the space, bullish and bearish.
I mean, look, as an organization where we are putting our bets is in those companies, and this is both through, like, for example, our partnership with Centrifuge, companies that are really fueling this transition. And so, you know, I'm not going to come up with a call on specific crypto assets or any of that kind of stuff as a regulated entity, but we see this transition onto the infrastructure plays in blockchain as being really like the key long-term growth areas. And that includes, you know, payments, it includes stable coins, but it includes a lot of the underlying tokenization infrastructure as well.
And what are you bearish on? Anything stick out that you think is just a fad, just hype? And the sectors, you know, similar, like payments, stable coins, tokenization, 100% agree.
Yeah, look, I think that some of the stuff that has happened around kind of Web3-ish things that are more entertainment driven, I see a little, I struggle to see that. The other areas where I just don't understand, and maybe there's an incredible opportunity, but I haven't gotten my head around, is all these people are trying to integrate sort of blockchain and AI. And it feels to me, you know, it's a little buzzwordy. And again, I don't know enough about it. And so maybe there's something there that I'm missing, but those are areas that, you know, they're certainly not a focus for us. Let's put it that way.
Crypto AI's buzzwordy is a nice way to put it. I think you're absolutely correct on that one. And you're right. Web3 gaming, like some of these things, maybe they're just early, or maybe they got a little overblown. The metaverse, there's a couple of those things in there as well. But generally the trend we're seeing and where, you know, people are putting their money where their mouth is on payments, stable coins, infrastructure for not traditional finance, not decent, just finance to come on chain and disintermediate a lot of the rent seekers of you know, an old world. So Nick, thank you so much, man. It's really been a fun conversation, and would love to have you back again soon once we eclipse the 4 or 5 billion mark on Janus Henderson. we start getting those numbers up.
Yeah, thanks, Robbie. Good to be here.
All right, we're live. Tony, welcome to the show. It's a pleasure to have you on.
Yeah, you too. Good to be here.
Likewise. Well, I'm really excited to have this chat. We've been hearing so much about stable coins, and Polygon is the sponsor of this segment. And they recently have had a lot of exciting and interesting things that have happened on their chain. $500 million of BUIDL has been transacting. People are kind of coming up with their not quite conspiracies, but everyone's speculating as to what this could possibly mean. So there's a lot of excitement around this, as well as the stablecoin super cycle that we are calling it. You guys are at the heart of this industry and powering the convergence of Wall Street and on-chain finance and digital assets with is it Ubix or Ubix? I want to make sure I get the pronunciation right.
You can pronounce it however you want. You could do Ubix, Ubix. You can say U by X. I don't mind. You can say whatever you like.
I love it. I love it. Well, we're gonna make sure that stablecoins become ubiquitous. That's for sure.
That's the story.
Absolutely. Well, I've been in the digital asset crypto space here for a while. I'd love to hear, since it is your first time on the show, how you got into the space.
Sure.
And just kind of the story about how you came to be here on stablecoins.
Yeah. Well, look, I've been working in what I now call, what everyone calls TradFi for 30 years, and always in the traditional payment space. And I've done every kind of payment system in the TradFi space that you can possibly imagine. My very first job was working on traveler's checks, which I'm sure you've never laid hands on a traveler's check because they're essentially gone now. But look, I was working on all different types of payments, foreign exchange, in corporate cash management the last 20 years for a big American bank, Citibank. You might have heard of them. Mm-hmm. And in the last couple of years, I turned my attention to working on tokens and chains. But up until the US election, really the story from the US regulators was not very friendly towards public chains. There was really a big keep off the grass sign for public chains. But then after the US election, things changed, and it became obvious to me after the election that banks in the course of in the natural course of things would migrate onto public chains if they were allowed to do so. And I also realized that stablecoins, tokenized deposits, tokenized money market funds, this is not the origin of crypto, but those kinds of instruments on chains would be super, super compelling. And so I decided to spend zero more time on private permission chains and try to incorporate stablecoins into the regulated financial system in a good way, and in a way where, look, I kind of think it'd be really neat if the worlds of TradFi and Web3 came together in a way where peer-to-peer transactions kind of got delivered in a way that the Bitcoin white paper kind of wanted to do. Albeit with a compromise, and that compromise is it's going to happen in stablecoins, which are pegged to fiat currency and not in a non-sovereign currency unit. So there's a very strange and interesting synthesis, I think, will appear between the original ideology of crypto and what will emerge from stablecoin ubiquity.
Yeah, I'm extremely excited to hear you describe this vision that you have and how you made the transition from the traditional financial world, as we've come to call it, into one that is on chain, because we also recognize a lot of the same benefits of this technology. And you described this as you were working at Citibank, and you sort of recognized how compelling blockchains were, but not just private blockchains. You recognize that from the public blockchain landscape, this is where composability and liquidity ultimately coalesces. Could you just reinforce in our viewers why it's so important that as enterprises come on chain, why is it so important that they come onto a public blockchain and not one of these consortium walled gardens of a private blockchain?
Yeah, it's that's almost like the critical question. There's nothing wrong functionally with the private chains. It's an adoption problem. For 10 years, the banks and the traditional players have been doing POCs and experiments, and the experiments are, in one sense, they're ridiculous, because what the banks and the traditional players say to themselves is, does my use case work on a blockchain? And the answer is yes, because the blockchains are just like Turing complete computers. So of course your use case works on on a blockchain.
You have a ledger, don't you?
Yeah,
This is a ledger upgrade.
Exactly. If your use case works on a relational database, your use case works on a blockchain. So that's, does my use case work on a blockchain isn't a good question. The answer is yes. And actually it works on a private blockchain or it works on a public blockchain. The big difference is that in the private blockchain world, you have a significant adoption problem. Now look at the dozens and dozens of attempted consortia in private blockchains, and they've all failed, or they're failing.
Mm-hmm.
And so the truth of it is that the public blockchains already exist. They already have users. And so you don't have the boot problem. All you have to do is to actually decide to, it's quite interesting that what mental model do you bring to what is a blockchain? I see a blockchain like it's a venue. It's a venue where people transact. In a bank in the 20th century didn't find it strange to put a branch on the high street, because that's where people congregated to do business. Mm. A bank in the early 2000s or late 90s didn't find it strange to put, mobile banking and internet banking on the internet, because that's where people were doing business. So why is it a strange idea to set up shop in a blockchain where people are congregating to do business? So to me, it's a natural evolution. You want to follow your customers where they are. Mm-hmm. You want to set up shop where your customers are. If you don't set up shop on the public chains, then they're not going to use you.
Yeah. I think this is a really important point, and you described this, and I think it highlights why the path dependency is so important, because we saw such an enormous capital movement on chain. If some of the private blockchains have been spun up maybe earlier, or they had rolled out quicker, then we would have seen liquidity coalesce there. But now that public blockchains have amassed so much liquidity, and again, $500 million of tokenized structured products on something like Polygon, which is a public chain, these are now the venues as you described them.
Yeah.
And so this is where we're going to see continued adoption coalesce around them. And so I'm curious, maybe to learn a little bit more about 𝘗𝘗𝘏𝑥. How do you help to facilitate the enterprises that, they have some existing distribution, some existing customer base, and are now starting to adopt and kind of make their foray into the blockchain world? What is the story, and how do you help to onboard some of these enterprises onto public blockchains?
Okay, so if you look, I just start with very basic building blocks. If you believe that we're moving into a world of tokens and chains, but then if you say to yourself, look, I don't know which tokens are going to win, and I don't know which chains are going to win. Obviously, we're on the Polygon sponsored segment, so Polygon's going to win, right? But let's say that you don't really know which token's going to win and which chain is going to win. The basic thing that you know for sure, if you are any bank or any fintech on the planet, is that you need a wallet. And you need a wallet capable of connecting to multiple chains. So this is the planning assumption everyone should have. Everyone should get used to the idea that everyone on the planet is going to have access to a wallet which is connected to multiple chains and capable of processing multiple tokens. That's the playing field. That's the arena. Now, the beautiful merger of TradFi and Web3 is when every bank and fintech offers a wallet. Now, I want to be very clear. I'm not against self-custodial wallets at all. Self-custodial wallets are freely available. And if people want to use self-custodial wallets, they should use self-custodial wallets. What is not freely available is a wallet provided by your bank or your fintech. That's not freely available, but it will become so. This is a firm prediction. You know, I firmly predict that every bank and fintech on the planet will offer a wallet, because that's the new form factor to deal in this world of tokens and chains. So if you just personalize this, not personalize it because you're a crypto native guy, but your second cousin who isn't crypto native, if they want to be able to receive a stable coin, but actually they just want the money to be received in stablecoin format and then turned into their fintech balance or their bank balance, then it would be really convenient for your second cousin to have a wallet provided by their bank or their fintech. And then the stablecoin goes into that wallet and the bank converts it into a bank balance. Now that presents a problem for the bank or the fintech. And the problem is there are going to be hundreds of tokens. There are going to be hundreds of different stable coins, different tokenized deposits, different money market funds. The bank has to turn those things into cash. And so this is where a clearing system comes in. Because in order for your second cousin's bank to give your second cousin cash, your bank needs to turn the tokens into cash. So you can think of Ubix just as a black box. Your second cousin's bank gives the basket of tokens to Ubix, and we give the bank cash. Now, how we do that within the black box, I won't open it up too much, but it's a way of turning tokens into cash without being an exchange. So we do not act as an exchange. We act as a clearing system, not as an exchange. And that's a very, very fundamental difference.
Yeah.
Because in an exchange, you're not guaranteed par value redemption. We're seeking to guarantee par value redemption. Like a stable, if your second cousin deposits 5 different stable coins from 5 different issuers for $100 each, your second cousin should get $500.
Right. Right. And what the second cousin may not realize is that this stable coin is trading at 1.01. This one's at 0.99. And they want the $500 and they want to be abstracted away. And basically all this is average out at par, like you're saying.
Yeah.
And this is
sorry.
Go ahead.
This is the thing about like these different worlds colliding. Like, you know, your world of crypto is one where stablecoin is an instrument that trades. And my world of 30 years ago, from when I started working with checks, is a world where these instruments clear. And so the real answer is that stablecoins, banks and fintechs can actually process stablecoins like checks. And that's the way that so banks and fintechs don't want to act as exchanges. When you take a check to your bank, they're not buying it from you. They're depositing the money in your account after getting money from the issuer. So I'm kind of like my age on this is a blessing and a curse, because, you know, crypto guys don't know checks and traditional people don't know crypto. And so I'm slightly like in the land of the blind, the one-eyed man has got some insight, because I'm straddling these two worlds of checks and stable coins.
But between the two of us, we can square this circle. We can balance.
Right.
And so I love to learn more about your world in checks and how stable coins can clear similar to checks.
Yeah.
Because I live in this hyper financialized world where everything is trading and it's a constant state of flux. But your
Right.
world seems a lot more stable, a lot more even keel. And I think that's what banks particularly enjoy.
Well, I mean, you will enjoy this as well. I mean, at the point at which stable coins become ubiquitous, what are we talking about? Look, if you add up the revenue that all of the stable coins make, I mean, maybe you get, I don't know, maybe you get $17 or $18 billion, and that might sound like a lot of money, but it's not, because the total payments TAM is $2.5 trillion. So what I think is happening is this: everyone on the planet is going to have a wallet. Those wallets are going to be connected to multiple blockchains. There will be many stablecoins, tokenized deposits, many cryptocurrencies, tokenized money market funds, real world assets. And this form factor will take over the entire payments TAM. Every payment type, domestic payments, international payments, cross-border payments, every payment will fall to this form factor, because the token on a public blockchain is the general purpose technology. If you think about it, a stable coin is a use case of a general purpose technology. And I give you the analogy that I like to use. I used to have an alarm clock beside my bed. I used to have a Walkman. I used to have a calculator, and I used to have a landline. And now I don't have any of those things, because they're all incorporated and subsumed within my phone. And people at the moment, so what happens in technology is the general purpose technology subsumes the special purpose technology. So in payments, the special purpose technology is cash, check, credit card, debit card, ACH, SWIFT, etc. These can all be subsumed within the world of tokens on public chains. And that's what's going to happen.
Yeah. And once that happens, we're going to see the likes of, like you mentioned, all these different form factors in the specific case. Right now, the tendencies for a lot of the founders of companies in the tokenized on-chain financial world to build these everything apps. There's one place to rule them all. Robinhood is doing this. There's several companies that are doing this, and they're trying to build everything in one, because it's all right there on our phone. Everything is tapped. And if you can have a depository institution right next to a financial institution that can handle trading and investing, then we have an opportunity to verticalize this entire stack. And so when you're looking at this and you're building infrastructure to help this, I'm curious how, just to learn more about the clearing process for stablecoin.
Yeah.
And you were at Citibank, and you helped to build the city's regulated liability network before founding UBIT. Was this when you were using traveler's checks and you were working to clear these? I just love to learn more about how this clearing process works, because again, all of these stable coins from my perspective are in flux, some trading at par, some trading above or below par very slightly. But if you can go direct to the issuer, then you can mint and redeem these at par, and then transfer or clear those on behalf of the bank that is looking to deliver the end balance to the end consumer. What is the process to make this happen, and how similar or different, or how much can you rely on the infrastructure that you built in this regulated liability network? How have you been able to extend that in the application of blockchains and stablecoins?
So I think the most useful thing I could do to get like a deep understanding of where do these worlds combine, and to do that, I'd like to talk about something which, I mean, you don't need to be familiar with it because it's like jargon. It's something called a negotiable instrument. So here's what a negotiable instrument is. You give me $10 and I write on a piece of paper, I owe the bearer of this piece of paper $10 payable on demand, signed Tony. So when I write that piece of paper, I've issued a negotiable instrument. Now, what can you do with that? So I've got your $10, right? I put your $10 in my pocket. You know it. So I'm a fully reserved issuer, right? I'm a fully reserved issuer of a piece of paper. You know, that piece of paper is now in your hand, and that piece of paper is a token. So what can you do with it? So the first thing you can do with it is you can come directly back to me and say, give me my $10. That's a little bit like you going to Circle directly. If you're an institutional client, that's like you go directly back to Circle and get your money back. The second thing you can do with that piece of paper is, let's say that I disappear, and you can sell that piece of paper to somebody else. You can trade it. Now, if you sell that, that's a piece of paper where the issuer is Tony, and Tony's got $10 in his pocket, so he's fully reserved. So you can sell that item, but someone might not give you $1 for it or $10 for it. They might give it to you at a discount, and they should give it to you at a discount because there's counterparty risk on Tony, right?
I think Tony's a good guy. You're not too
well. That's okay, but you might buy it for $10, but somebody else might buy it for $9.95, and that's what the negotiability means. Negotiability means that the price isn't fixed. So these two modes exist in stablecoins, right? So you see the analogy between the piece of paper can go back to the issuer, the piece of paper can be traded. Now here's the important question. Is the piece of paper intrinsic? In other words, if I had written that IOU on a clay tablet, does it mean the same or different? It means the same, right? If I etched IOU $10 into a piece of metal, does it mean something different? Does the medium mean anything different? Doesn't mean anything different, right?
Right.
If I store that IOU on a relational database, does it mean anything different?
It does not.
Doesn't mean anything different.
Right.
So if I represent that IOU as an ERC20 token, does it mean anything different? It does not. So this is the key thing. When people define stablecoins, they often say it's a crypto asset with reference to fiat currency. It's not. That's not what it is. A stablecoin is an old-fashioned negotiable instrument wearing new clothes. So a stablecoin is a negotiable instrument. And we've had negotiable instruments for hundreds of years, thousands of years. And the funny thing is, there is one modality of what you can do with a negotiable instrument that exists in checks that does not exist in stablecoins. And that modality is you can take a check to your bank and get par value, and you can't take a stablecoin to your bank and get par value.
And why is that?
Because the banks view stablecoins as crypto assets, and they're afraid to touch crypto assets because the regulators have defined these things wrongly. So if the regulators would say, these are six magic, these are really magic words. They're magical words. The following six words, banks and in parentheses, fintechs, banks can process stablecoins like checks. Now, if someone in authority were to utter those words, the Fed governor, the Treasury Secretary, the president does a truth social, banks can process stablecoins like checks. Every bank, every fintech on the planet would start processing them like checks. And they would say, wow, there's a way for me to process stablecoins where I don't have to act as an exchange. I'm going to do that. Think of the plight of, like, community banks in America are scared about stablecoins causing deposit flight. But actually, if community banks open up wallets for their customers and enable their customers to receive stablecoins like checks, it's money into the balance sheet of the community banks. I mean, genuinely, these are 6 magical words that will, and it will unleash bank and fintech participation. Now, if you want to sell your stable coins in exchange, do it. If you want to take them back to the issuer, do it. This is a 3rd lane on the highway.
Mm-hmm. Yeah. Now, I think you'd agree with the statement that not all stable coins are created equal.
Yeah.
And we've got sort of this impending Cambrian explosion of stable coins.
Yeah.
Every Walmart stable coin, Amazon stable coin. We had the Wyoming Stable Token Commission. The
Yes.
state of Wyoming is going to be launching a stable coin. Stable coins galore. This Cambrian explosion, several orders of stable coins, all with different varying issuance policies, reserve requirements. The Genius Act did help to regulate and stabilize a certain subset of these stable coins, but generally, not all stable coins are created equal. So, kind of a loaded question, but I'm curious, do you think that whether it's the president or some issuer or regulator, will they utter those words that banks should accept stable coins as checks? And if so, how do we know what fits the criteria of stable coins that should be checks? Should it be all stable coins? Should it just be Genius compliant stable coins? Or is there some other list of criteria or formula in order to process which stable coins meet those requirements?
So let's work out, or let's think about how our civilization has solved these problems in the recent past, right? So in the US, there are 5,000 banks. There are 5,000 banks. Every single one of those banks can issue checks. Every one of those banks can issue checks.
Mm-hmm.
Now, does that mean there's fragmentation? No, there's no fragmentation.
Right, because all of those checks are fungible.
Because if I give you, like, there's 5,000, choose 5. If I give you a random selection of 5 checks from the 5,000, you don't give a damn about the issuer. You don't give a damn about the issuer. And I'm talking now about a cashier's check. I'm talking about a check drawn on the bank. If I give you 5 cashier's check from any bank in the land, what do you do with it? You take those 5 checks to your own bank. So that quality of you not caring about the issuer is a very important quality called singleness of money. It means that a dollar is a dollar. You don't care about the issuer. That's the no questions asked principle. You give those 5 checks into your bank and you don't care about the issuer. So I say you should be able to give the 5 stable coins into your bank and not care about the issuer, as long as, and this is the case with the banks, all those banks we're talking about in the US, they're all regulated. So here's another parallel. Do you know how many card issuers there are on the planet?
As in Amex, Discover, Capital One, these sorts of.
Well, there are 16,000 card issuers on the planet.
Okay.
Is there fragmentation? No. There is zero fragmentation because, like, I come from the UK and I come into the US, and in the US I use my UK card and I go to Macy's, and Macy's doesn't care about the issuer. And there are 16,000 issuers. So when I see people say, well, there's going to be lots of stablecoin issuers and that's fragmentation, I have to laugh. This is a failure to understand the previous cycles of payments technology. There will be this. I've also heard people say that are only going to be a few stablecoin issuers because there's a power law. I have to laugh. So in the age of checks, the market structure is everyone can issue checks. There's no bank that can't issue checks. There's no bank that can't receive them. In the age of debit and credit cards, everyone can issue, everyone can receive. In the age of ACH and faster payments, everyone can send, everyone can receive. In the age of stablecoins, I guarantee you, there will be thousands of issuers and it will be no problem whatsoever. because you'll be able to take any 5 stablecoins from any regulated issuer to your bank, and your bank will deposit them like a check. No problem. So, you know, we have to place, all I'm asking for is this: let's place stablecoins in the historical context, and everything is quite clear. How things will turn out is quite clear. There's nothing in the stablecoin that will make it depart from history in that respect.
Shifting gears a little bit to CBDCs, because this does draw a distinction between stable coins and CBDCs. And so when you're looking at CBDCs and you think to yourself, oh, I think to myself, look, the CBDC is a stable coin, but a stable coin is not a CBDC, meaning that a CBDC sort of has these centralized properties to it. Stable coins are a wider basket. And so when you think about stable coins in general, all fungible and issuance, everyone is sort of treated equally. Do you put CBDCs into that category as well, or do you draw a distinction between the two?
So the distinction that exists between CBDC, tokenized deposit, and stablecoins is a kind of, it's the reason why people make that distinction is because they're lumping together the issuer with the instrument. So actually, what is the instrument? The instrument is a token that can be redeemed at par value on demand. Who can issue such an instrument? A non-bank like Circle can issue such an instrument. A bank with a balance sheet can issue such an instrument. A central bank can issue such an instrument. So let's think that, again, in the US context, there are different types of issuers of checks. So a traveler's check was issued by a non-bank. There are small FDIC regulated banks that are big OCC regulated banks. You can have a check issued against a money market fund. Back in the day, your credit card company used to give you a checkbook. You could write a check against your credit limit from your credit card company. So the check is the instrument that is capable of being cleared, but the issuer doesn't have to be the same kind of issuer. So to answer your question directly, in my definition, a CBDC is just a stable coin issued by a central bank. A tokenized deposit is just a stable coin issued by a commercial bank. And what we call a stable coin is the fact that the stable coins that we see today are pre-funded instruments doesn't mean that they always have to be pre-funded instruments. It's just something, the best definition of a stable coin is in the name. It's something which is stable against the fiat currency. It's something that if I was to give you like a traveler's check and a check drawn against an FDIC bank and a check drawn against an OCC bank and a check drawn against a money market fund and a check drawn against a credit card issuer, you don't give a damn about the issuer. The property that we're looking for, the way that you incorporate stablecoins into the financial system, is you get to the point where you don't give a damn about the issuer.
Yeah. I'm now building on this as we're thinking about clearing these stable coins like checks between issuers and banks and delivering fiat.
Yeah.
How do you, just to open up the black box a little bit, if you don't mind, how do you actually do this so that we can understand a little bit more? Now that we've got the issuance, we've got the stable coins, we understand how checks are processed. How do you actually clear these payments?
Okay, so clearing, you basically have two flavors of clearing in the world, and you've got the smart form of clearing within the kind of markets area where people have central counterparties and there's margining and there's all sorts of fancy things going on in securities clearing. And then you've got very basic payments clearing and check clearing. So check clearing check clearing and stablecoin clearing is like this. This is going to be my stablecoin, okay? Stablecoin gets received into my wallet at Wells Fargo. Stablecoin has to get turned into dollars because Wells Fargo want to give you the dollars. Wells Fargo give the stablecoin to me. I give the stablecoin to the issuer. The issuer says good stablecoin. The issuer gives the dollars to me. I give the dollars to Wells Fargo. Wells Fargo gives the dollars to you. It's just a DVP. It's just a DVP. The stablecoin goes one direction. The dollars go the other direction. Now, again, this mechanism is only invoked when you want to turn the stablecoin into fiat. There's no, again, I'm not saying that is what you should do. If you want to hold on to the stablecoin and then send it onwards, by all means do that. I'm only my mechanism only comes into play when the token has to get turned into fiat.
Understood.
Now, when would that be useful? So imagine now you're a corporation, and imagine that you sell $10 million of services per day over your website. And you've got $10 million worth of stable coins coming in every day. There are going to be many, many issuers from many countries. So you might end up with a wallet with 100 different stable coins. You don't want 100 different stable coins. You want to consolidate that all down. Now, maybe you want to consolidate into a single stable coin, or maybe you want to consolidate it into cash on your bank account. So the only place that my thing comes into being is when people want to turn the tokens into cash. And that's not always, that's just sometimes.
I can imagine a scenario where to the end consumer, a business person that has a bank account and has a wallet at that bank account, the number that's shown as far as my balance at that bank is a combination. It's a sum of the stable coins and the fiat that I hold at that bank. And I can understand how the number from my perspective won't change, but on the bank's perspective, they might go and facilitate in order to balance their books. And they might take the liberty on my behalf to clear some of those stable coins into some fiat in order so that they can efficiently process transactions.
Well, you put yourself again in the position of the CEO of a community bank. If you give your customer a wallet and the stable coin goes into that wallet and it sits there, the stable coin is not on your balance sheet. It's essentially in custody. You know, assets in custody are not on a bank's balance sheet. So what you want as the CEO of that community bank is to convert it into money on your balance sheet, because then you can use it for lending. So I would suggest that the first thing that the first service that a bank is likely to offer is conversion of the stablecoin into a bank balance, because the bank wants the money on their balance sheet. This is a good service. The reason why this is good is because if every bank and fintech in the world have wallets and offer that conversion service, then we've dramatically increased the supply of regulated wallets. That's good. Again, I've got no problem with people having self-custody wallets if they want to. But en masse, let's say that the US pumps $3 trillion worth of stablecoins into the planet. Do we want $3 trillion on unhosted wallets? Like, I think if that's the case, what will happen is the central banks around the world will move into a very unfriendly stance against stablecoins, and that's not what we want. We want governments around the world to consider American stablecoins a gift. When back in the day, when people from America traveled into the rest of the world holding in their hands the American Express traveler's check, they were warmly received, and everywhere in the world, every bank in the world, every bureau de change, every hotel in the world accepted American Express traveler's checks with gratitude. And the reason why is because when, not you, but your parents went into Paris with an American Express traveler's check and they took that check to the bank, that bank made foreign exchange. That bank was very happy. Now, if the world gratefully accepted American Express traveler's checks, the world should be even happier to accept American stablecoins.
Mm-hmm.
And it's super bizarre to me that the dialogue outside of America is countries outside of America are afraid of American stablecoins. But if they catch them in their banks and fintechs, they're a gift. And something else happens. Once every bank and fintech have a wallet, then American stablecoins will no longer dominate because the distribution channel will be there for stablecoins from every country. And, there's no reason when a Japanese yen stablecoin comes into America, an American bank or fintech makes FX.
Mm-hmm.
So Japanese yen stablecoins in America are a gift from the Japanese to the Americans. American stablecoins going into Japan are a gift from America to Japan. So these are little bundles of joy. Stablecoins I define as being a little bundle of joy.
I love it. I love it. Tony, man, I got two more questions, and I know we're kind of running up on time, so I want to speed run. I love the concept that every bank and fintech is going to have its own wallet.
Yeah.
And this allows them to take receipt of the little bundles of joy that we're passing around the world. Will Ubix offer almost a wallet as a service, since you're building a lot of the banking relationships and you have experience with stable coins and building relationships with the issuing partners? Will you also offer a wallet to these banks?
We deliberately won't, because there are many great wallet providers. But what we'll do is we'll go to market with the wallet providers. So we'll go to market with the wallet providers and the chains and the analytics companies, and we'll provide TradFi with the equipment that they need to capture the bundles of joy. Right? Let's just call stablecoins bundles of joy from now on. Right?
I love it.
So this is the thing. We have to change the go-to-market, right? So wallet providers go to banks and they think they're selling custody, and chains go to banks, and every bank, the chains go to the banks and they say, my chain is the best. This is not the game. The thing that we're selling to the banks and the fintechs is the opportunity to catch stable coins and convert them, because then they'll make fees in FX. And our go-to-market as an industry, so look, I love Polygon, but if we try to go to an individual bank and say Polygon is the only chain to connect to, they'll be stuck for years. They'll be saying, okay, is it the right one? You're asking people to make a false choice. It's much better to say this to a bank. I just plead with everyone in our industry to think about this. Don't ask people to make a decision that they don't need to make immediately. The bank doesn't know which token or chain will win. What we should do is give them a wallet connected to all the chains. Once the bank has a wallet connected to all the chains, then the natural advantage of each of the chain will come to the fore. Some chains will be good for one use case, another chain will be good for another use case. But our the way that we get to positive network effects is we all say the same thing. Look, the baseline, every bank and fintech needs a wallet.
Yep.
Baseline. Let's start with that. That's the building block. Then the chain wars and the token wars happen on top of that infrastructure. But let's make the first step first.
Yeah. Well said. Last question. Through the research that we did on Ubix, we discovered that there is you're starting to explore the concepts of decentralizing this network.
Yes.
What does that look like to take this clearing network of stable coins and transform it into a decentralized network of clearing?
Yeah. We need to walk the talk of being in the space, and we don't want to build a monolith. The monoliths that we've got at the moment, like the the card schemes, for example. They've got centralized rule book and centralized technologies. We want to do something different. So we will have a rule book. We want it to have community governance, but in a responsible way. We'll have a technology stack that to begin with will be quite centralized, but we want it to be decentralized and resilient over time. So we just want to be, look, if you were rebuilding a card scheme from scratch today, you wouldn't rebuild the ones that we have today. So our thing is, let's use the best technology, decentralized technology available. But first we have to boot the network. We went live like in the last week. 6 months after forming the company, we went live. So we have to get things going, crank the engine. But our machine going forward, we want to be progressively decentralized.
Makes sense. Tony, congrats on going live. Congrats on all the great work so far. And thank you so much for coming on the show and helping educate myself as well as our audience on all of your experience and your insights that you gathered over the years. Really, really appreciate it.
Well, it's a great pleasure. And these worlds are coming together. And, look, it just takes a little bit of us each moving towards each other's space. So lots of people in TradFi, they've never seen a stablecoin. So the people in TradFi can take a step forward towards DeFi and Web3 by just getting a wallet and experience a stablecoin. And vice versa, if you're a crypto dude and you can't get to sleep at night, read UCC Article 3 and UCC Article 4.
Put you right to sleep?
Put you right to sleep, but also that if you get your head around the fact that stablecoins are negotiable instruments. So UCC Article 3 is the definition of negotiable instruments. If you get your head around the fact that a stablecoin is a negotiable instrument, the worlds really combine and the future of the stablecoin market structure becomes clear.
Yeah.
So this is about both worlds making a slight effort to get to know each other because we're on a collision course, man.
Yeah. Yeah, I think so. Ultimately, this is converging. It's important to get back to the basics, and I'm gonna check. I'm gonna check those out because this was a great opportunity to learn about negotiable instruments and all the things that you brought here today. So
yeah, cool.
I really appreciate getting the opportunity to know you, get to know clearing, and share a little bundle of joy with one another in the form of stable coins.
Exactly. The bundles of joy are going to be sent all over the world very soon.
Yeah, and the banks are going to do quite well via Forex.
They
Forex
will.
in the bundle of joy. Tony, thank you so much, man. Enjoy the rest of your day and have a great weekend. And
thank you.
Yeah, would love to have you on again soon.
Yeah,
congrats.
Awesome. Cheers. Bye.
Cheers. Love it. Absolutely great conversation. I love learning from these people that clearly have gone through history and gone through their business experience and business journey. In such a way in which they've picked up so many insights. And I love when people can come on and they can share these insights, and we can learn and we can share all of that information and knowledge with you guys. So thank you so much, guys. We've got one more guest. We're going to flip the screen and we're going to chat with Dan from Wormhole coming up next. All right, we are live. Dan, welcome to the show. It's a pleasure to have you on, man.
Great to be here. Thanks for having me.
Oh yeah. You guys just launched Portal Earn. Congrats on the product launch. Very, very cool to see. We just had a great conversation about stablecoins with Tony. Just passing around little bundles of joy around the world so that banks can make FX. And I mean, you guys have seen quite a bit of stablecoins go through the Wormhole bridge and ultimately anticipate that they'll end up in the portal and on Earn. Um, Man, I would love just kind of a foray into Earn. Maybe you could just give us, a primer on this launch, and then we can dig into it, all the positive consequences and second order effects as a result of incorporating this into the Wormhole stack.
Yeah, definitely. So Portal is kind of the main UI for people to use Wormhole going back to around 2021, about a year after Wormhole's like V1 launched. Portal back then was more of a token bridge for wrapped tokens, because that was basically the industry standard back then. And of course, over time, we've evolved to kind of native burn and mint models, and that's been integrated into Portal. So now comparing Portal now to comparing Portal to 2021 is basically just a completely different product. And the user experience has improved significantly, especially in the past year or so, I would say. And part of that is we were thinking about kind of our goals around volume and driving more users and how do we achieve that. In the solution, one of the solutions we came up with was Portal Earn, which we were kind of looking at as almost like an on-chain version of Binance Earn, if you will. It's a combination of like crypto loyalty programs with things like credit card programs, airline miles, we integrated status and things like this. And the goal is to really reward users. There's already been hundreds of thousands of users using Portal over the years, so why not reward them for doing so? And then on the integrator side, we work with a lot of chains and we work with a lot of asset issuers. And a lot of these partners of ours are already lining up to work with us on Portal Earn, because it allows them to work with us to really divert traffic to exactly where they want it to go, even within their chain. So an example is Unichain. We launched this yesterday with Unichain as the first kind of campaign partner. And we're able to incentivize specifically Sol and Hype to go to Unichain. And then even when they land on Unichain, we're able to give, not direct, direction, but suggestions of like, okay, here's a link to this pool that might be incentivized already on Unichain. If you're a user, go check it out after you land on Unichain. So you can imagine if you're Unichain, this is valuable because you're getting traffic driven to your chain, and then you're able to kind of divert that to even the specific parts of DeFi that you want to.
I think it's really counterintuitive for people to start to think about bridging something like Hype outside of the Hyperliquid ecosystem and going into Unichain, but it ultimately it proliferates these assets, and it kind of makes them ubiquitous across several different ecosystems. And you really kind of just have assets and bridges, and that they ultimately land on into these pools, but it makes up each of these ecosystems. And so you're incentivizing some of this activity. I also saw some more bridges kind of open up between Solana base. Hyperliquid is now going to Unichain. When you're thinking about incentives and ultimately like helping people recognize some of the opportunities in LPs and capital and where they can put that capital on some of these destination chains, like why did you choose Hyperliquid? Why did you choose to kind of incentivize this particular route? And then how do you make those suggestions? Like, hey, you have Hyperliquid, it's on Unichain, you should maybe go into this pool. What's the if you could open up the black box and tell us a little bit more about the formula that goes into it.
Yeah.
What is that?
Yeah, it becomes a lot easier to visualize. Obviously, if people go to the URL, it's earn.portalbridge.com. And it's you connect your wallet, and then you see a list of activities. Those activities basically are things that you can do to earn rewards, and that could be just a general transfer of a token, which I think is like a 3 XP per dollar transferred. And then the Unichain campaign is bumped up to 10. And the reason why, so go to that website, you can check out kind of how it's all laid out. And then for Unichain specifically, and then for any other chain, a lot of it's actually conversations with the ecosystem that we're working with. So in this case, our BD team was working with various contributors in the Unichain ecosystem, and kind of the output of that was driving Hype and Sol. As a crypto user, I would say those are two of the most, high volume, popular assets at this time. So it kind of makes sense that you would want those assets onto your new beginning to flourish DeFi ecosystem. So that's how Unichain decided to do this. And then we've got a bunch of other chain launches that are going to be coming as campaigns on Portal Learn. And there will be, different strategies even on our end with which assets are being incentivized, which kind of DeFi activities or pools are being incentivized. So it'll vary. And then as we have more and more of these campaigns almost like stacked on top of each other, the users using Portal Learn are going to have the benefit of actually getting to experiment with different ecosystems that they may have previously not necessarily spent the time to get to know.
Yeah, it feels like kind of yield farming is coming back too. This is a phenomenon that we're seeing really just take hold. And I remember this is how I got started because, I recognize there's opportunities that if you're looking for them, they are there. And, someone may be surface level aware of something like a hyperliquid asset, but as far as the opportunities that they can make, as far as earning some of those rewards, it becomes available once you start to look a little bit deeper. And so, now I think we're gonna try to get the portal up on the show. But while we're working on that, I'm curious, this is now another component to the Wormhole stack. You guys have vertically integrated several of these components by partnering with a lot of the chains, the assets that are out there and that are in demand. How does Earn complement the rest of the Wormhole stack? Like you said, a lot of people have been already using Portal, but now you're looping in Earn. I mean, generally the interop space is moving at a breakneck speed. What's your perspective on the landscape of interop these days, and how does bringing Earn into this help just round out this stack as a whole?
Yeah. I'll even zoom out a little bit more than that. Like your previous comment about Hype moving to Unichain and away from the Hyperliquid ecosystem, we really look at the crypto ecosystem as one economy. Of course, there's sub economies, but we think about an asset like Hyperliquid just like we would think about the dollar in the real world. Like you've got dollars in the US, but there's no reason that doesn't flow to Europe, that doesn't flow to Asia. Of course, dollars are everywhere, but these sub economies are like blockchains. So that's how we see assets. We don't see any asset like ETH, like Sol, being limited just to that blockchain. This is all one economy, and Wormhole is connecting all that together, which is why we're so excited about working on a project like this. And I actually previously worked on several blockchain teams. I was in the Polkadot ecosystem for a while and a few others. And that was, I've learned a lot zooming out, being on Wormhole now. And we work with everyone versus these L1s. They're all, super competitive with each other, fighting over the same users and same liquidity oftentimes. So it's really made me even more bullish on the industry, just seeing how it doesn't really matter what new chains launch. It doesn't matter what new chains win. There will be this multi-chain economy, and that's already kind of been established. That wasn't kind of a generally understood concept back when we started Wormhole in 2020. So multi-chain is here to stay, that's for sure. And then how we're looking at Portal in general, and I would say it's more about Portal even than Portal Earn. Portal Earn is like it's the reward and loyalty program that we're putting on top of this. But even more recently, we just announced Portal Swap just a week ago too. This is essentially a DEX. It's for same chain swaps. So if you want to swap Sol for USDC on Solana, you can make that swap, from a Solana wallet to a Solana wallet right in Portal. That's actually powered by Mayan, which is one of the top intense-based cross-chain swaps protocols, but they also power same-chain swaps. So Portal has gone from being, of course, a place where you can transfer tokens from one chain to another, but now you can also accomplish another goal if you want to make a swap on any given chain. And this is really for us just step one in growing Wormhole Portal into a full-on multi-chain trading experience. We're looking at this as a long product roadmap. This is step, I guess, 2 after token transfers, swaps, and can't say exactly what's next, but just imagine some of the bigger DeFi protocols in the industry. These are the types of products that we're building into Portal, and we'll continue to roll out more and more kind of DeFi products so that when a user comes to Portal, like the way we were thinking about it before is like, if you're in New York and you get on a subway, you have a goal. You want to go to a restaurant, or maybe you want to go to your office. But we wanted to provide not only that transportation in between, but we wanted to help them accomplish the goal once they reach that destination. So why only provide a multi-chain transfer? Why not allow them to provide, or why not provide them a DEX swap on Solana once they reach there? And then even when they're on Solana, what if they want to do staking? What if they want to do other forms of trading? This is really how we're thinking about the evolution of Portal.
Yeah. And through this, we can get so much more done. We can accomplish so much more by compressing the amount of events or actions that we can take into a single one. It's less time, it's less thought, it's more innovation. After we're through that, we can continue to work down the line and get creative about what's coming up after that. I want to talk a little bit more about what is happening at this earn level and just kind of help users maybe navigate through this program. And so I'm looking at the blog post now. Baseline reward rate is 2 XP per dollar transferred and 1 XP when using stable coins. And so does that mean you get 2 per dollar no matter the asset, but you get an additional 1 when you're using stable coins? Is that 1 in addition to?
No, it's actually less. So
Okay.
one for stable coins, 2 for non-stable coins.
Got it.
And then as you, I think in the blog it has this too. And as you go through if people are going through the UI at all, there's some boosted assets. So these will be limited. So I think right now it's Sol only.
Right. It is Sol earns 3 XP per dollar.
Yep. So this will continue to also grow into new boosted assets. And then there's the boosted chains. So right now it's also Solana and Hyperliquid are the 2. And then the 10x is right now on Unichain. And like I said before, we'll continue adding new chains there. Imagine some of the bigger launches coming up this quarter, new chains that we're partnered with. We'll likely have a campaign going live with those launches. So definitely be on the lookout for, if you're going to a new chain, Portal's going to help you get there, and why not go through this program and earn points while you're at it.
And I'm learning now another way in which we can earn XP is by staking W, and that's coming soon to Portal.
Yes.
Okay.
That's in the next release. This was actually a ton of engineering work.
Okay.
It took many months. So we've done a whole first round, and then the next kind of release, the next version is going to include staking.
Very cool. So I can earn the most if I'm using boosted tokens, boosted chains. I can earn 4.5 XP per dollar. If I'm going from Hyper EVM or Solana and I'm bridging Solana, really bridging Solana over to Unichain is going to be probably the best.
Exactly.
Okay. So there, and was this something that you guys realized, like after some negotiations or conversations with Unichain? Do they say to you like, "Hey guys, we want to get some Solana over on Unichain. Could you help build out a program that accomplishes this?"
I'm actually not familiar with exactly how we landed on those assets. We have a whole team kind of that's been working on this stuff, but if I were to guess, these are the assets that someone or some team wanted to incentivize. And also there's already incentive programs live on Unichain. They've been live for I think 3 or 4 weeks. So there's probably some relation to those assets on Unichain as well within their DeFi ecosystem.
Beautiful. And can you give us a little bit more insight into what this XP ultimately will turn into? There's some kind of vague mentions about it in the blog post, tiers and whatnot, but could you allude to like what this could possibly mean down the line?
I would say rewards. That's about all I can say.
We'll let our audience draw the connections at their leisure. Okay, I think Leo, can we bring this up on the show? Can we get a view of Portal Earn? Bang. Okay. There we go. Dan, you should see this if you click on the square there. So we've got full send, earn XP. We're a little zoomed in here, but we can see this. Earn XP, go Hyperliquid and Solana to Unichain, boosted tokens and chains, and we can earn activities. And there's all these things that we can do to earn more XP. Guys,
if you scroll down, you'll see more of these.
Beauty. Transfer stable coins, transfer tokens. I mean, you guys make it easy. We want this. We want XP. We want boosted chains, boosted tokens, and more rewards. And so, man, you guys have come a long way. I think, we saw the Wormhole W token launch. We know where you guys are headed. How, if we're zooming out a little bit more now, how do you think about the interop space is just so cutthroat, so competitive. Like, where are you guys at in terms of market share? What are the routes that you guys are dominating? And what do you think comes next here?
Yeah. Market share is interesting in the interop space because it tends to fluctuate with new chain launches. If you go back, I think around the beginning of the year, this year, we were leading. It's basically at this point, the interop space at the messaging level is a two-man race. It's us and Layer0. Layer0's done a great job, to their credit. We've done a great job over the years. Chainlink has almost no adoption. They do a lot of press releases, but that's about it. On the interop side, they've done a great job on the Oracle side. But as far as us and Layer0, we've got two big chain launches coming up in the next month or so. So I'm expecting a ton of new volume on the Wormhole side in the next couple months. And then as far as what we're looking at going into next year, there's a couple themes. I'd say institutional assets is one where we're clearly the leader in the space. We've got around 3.5 billion in AUM using Wormhole right now, and that's teams like BlackRock, Apollo, Van Eck, Hamilton Lane, and several others. In our partnership with Securitize, who's been a great partner of ours for a little over a year. We're going to continue to grow the AUM of the funds that are already using Wormhole, and we're going to continue helping them expand to new chains. Like I said, even these institutions are thinking about crypto as like we are. It's not one chain. They want to launch, quote unquote, globally across every chain that they possibly can, because that's new users, that's new market share. The second category for 2026 is stablecoins. USDC and USDT are doing a lot of volume through Wormhole now because of Portal. Especially on the USDC side, Portal makes it really easy for users to send USDC across chains, and it's still leveraging the USDC's CCTP protocol, cross-chain transfer protocol, kind of behind the scenes, but leveraging the Wormhole front end. And then another thing that we're really excited about within this stablecoin category are these stablecoin platforms, and I would call out M0 specifically. M0, I would say, is still flying a little bit under the radar because they are a platform, but their stablecoins are getting headlines. Teams like the MetaMask USD are using M0 under the hood. There's about 5 or 6 different stablecoins now that are out on the market, leveraging this kind of out of the box. Someone compared it to pump.fund for stablecoins is basically what M0 is. So they're pumping out a bunch of new stablecoins, making it really easy for the asset issuers. And then Wormhole messaging is behind the scenes, helping these things be natively burned and minted and kind of natively multi-chain from day one, wherever they launched.
Love it.
Yeah.
Yeah. I mean, it makes a ton of sense. And this is a balance for you guys. And I'm actually curious just to learn a little bit more about the mentality and the philosophy at Wormhole, because XP is great. Retail wants rewards. That's great for retail, but enterprises, are thinking, they're thinking on the scale of like you said, launching globally, thinking a little bit different than XP. And so when you're expanding, you're looking at the strategy broadly, and you're looking at how you can maximize stablecoin flows. You're looking at issuance. You're looking and to partner with some of these enterprises. Can you describe a little bit more about some of the partnerships that you have with M0, with Securitize? How are you leveraging these partnerships to ultimately provide the best experience for enterprise and land more of those? Are they exclusive partnerships? What are enterprises using Wormhole for now? How do you help them facilitate that?
Yeah. An interesting thing after this whole, it's been about 2 years of these conversations. And then in the past year, a lot of it started to go live. And looking back on it, one of the things we realized is that the thought and the work and the extra effort that we put into the security and decentralization of the network ended up paying off a lot. About, what was it, 2023, Uniswap did a bridge assessment back then when they were making a decision around Uniswap governance, expanding to new chains and using a bridge to send that data cross chain. And Wormhole came out of this 3-month study that this independent group did on bridge security and decentralization. And Wormhole came out on top of that report. Axelar was kind of second. They had a one condition they had to update. And then Layer 0 came out not approved because of the centralization and kind of the security risk of Layer 0 at the time. Layer 0 probably has made some updates to their protocol since then, but there's a lot of risk in using a 2 of 2 multisig to run a bridge that's doing hundreds of millions of dollars. And that still happens today.
Who does that? Layer 0?
Yeah. They have this DVN thing that was branded as decentralized, but the reality is that a lot of it goes through a 2 of 2 multisig. And when you see these days where they're doing tens of millions of dollars, hundreds of millions of dollars, I'm actually a little bit worried about the centralization risk there. And when we had these conversations and we did a lot of the due diligence with teams like BlackRock, it always came back to the fact that we had 19 independent, doxed, public validator companies running Wormhole's network, including people like Google Cloud, Kraken, and several others. And that paid off for us. It's not easy to run a 19 validator network versus a 2 of 2. And the reason is, for us to expand to a new chain, let's talk about Monad, for example. All 19 of these validators have to learn how to use Monad. They have to spin up a new node and run a full node for Monad. Doing that with coordinating 19 entities versus doing that with 2, and one of them you run yourself, is a lot easier. So there's a benefit in being able to expand faster. But when we were talking to BlackRock, they want to know who these validators are.
Right.
And then a lot of these institutions want to be able to even legally take action if they had to in the worst case scenario. So this work that we put in and the thought that we put into the architecture helped us with that Uniswap report. It helped us with winning the BlackRock deal, the securitized deal. And then now these institutions, they kind of see Wormhole as the default option because the security is so important and the decentralization is so important. And a third thing also is just open source code. Wormhole is 100% open source, and that's also not the case with a lot of the other interop providers. So these institutions want to be able to go into the GitHub and look at what they're using and not be using this kind of essentially a black box.
Yeah, naturally. If I'm BlackRock or Securitized, I'm thinking the same way. Dan, this has been an incredible conversation. I'm glad you brought the spicy takes, and Portal Earn is live as well. So it's been a fun conversation. You're our last guest of the day. Wrap us up. Last guest of the week, man. Any closing thoughts as we go into the weekend?
I would say the timeline's been bearish, but I'm extremely bullish. So I think people should be positive. We've got a lot of good macro news coming. Rate cuts are not stopping. Trump wants the economy to do well. I think in general, the next 6 months look very positive for me. So I'd say stay positive. We're building amazing things in this industry, and I think we just got to keep our heads up and fight through the short-term noise and keep an eye on the big picture.
Love it. Very cool, man. Stay positive, stay patient, and have a great weekend. Dan, appreciate you coming on. And
have a good weekend.
Yeah, we'll talk to you soon. Keep up the great work.
Thanks, guys.
Cheers, brother. All right, guys. Incredible. That's it. Great show. Man, Dan, dropping some bombs. Has absolutely no remorse. We're going to clip Chainlink. We're going to chip M0. We're going to clip Layer 0. These things are going to make waves. What a wrap. What a show. Guys, thanks for another great week. Really enjoyed today's conversations. Talked to Dan. He brought the spicy takes. We talked to Tony from 𝘗𝘗𝘏. Love what he's doing. Love that he was able to bring a lot of experience to the show today. We could share that with you guys. We had Janus Henderson. We had Nick from Janus Henderson, who, man, it's crazy to see. You have Tony, super experienced guy, came from the world of traveler's checks, now applying this business logic to stable coins as a crypto native company, 𝘗𝘗𝘏, but applying a lot of tried and true methods that were real and made by travelers checks. And then you've got someone like Nick, super crypto native guy, but he's doing it at a traditional Wall Street asset manager and capital allocator in Janus Henderson. So you really do have the convergence of these two worlds. It's really, really cool to see. And then obviously we started off the show with Alvara and their ERC 7621 standard. That's it, guys. Great show. Thanks so much for joining. Thanks so much for watching. We're going to be back next week with another full slate. You're not going to want to miss it. In the meantime, have a great weekend. Stay patient. Stay positive. We'll see you next time on Rollup TV. Bang.